Do you know what non-dilutive funding is? In today's video, I'm going to fly through a dozen ways to fund your tech startup without giving away a piece of your company. My name is Susan and I share financial tips with founders and CEOs, especially around scaling your business. In today's video, I'm talking non-dilutive funding with startups in mind. So question number one, what is non-dilutive funding? Well, it's any kind of funding that does not require you to give away a piece of your company. So think of things like loans, grants, tax credits, and subsidies. Conversely, dilutive financing is raising equity from angel investors, VCs, private equity, that sort of thing. Okay, so we clear on that? All right, so let's dive in then. So if you've just launched your startup, the best non-dilutive funding option, I believe, is a BDC startup loan. So the approval process is pretty straightforward if you have a decent business plan and a personal credit rating is decent. So also keep in mind if you're 18 to 39, there's Futurepreneur, and that offers collateral-free loans, which may also be an option. The thing is, startup founders commonly burn through their personal savings and max out their credit cards first, which deteriorates your credit position. What you need to know is that the startup loan is going to require a personal credit score in order to secure the loan. So make sure you start with the startup loan sooner to leverage your personal credit rating. You'll also maintain it longer because it doesn't have the same impact on your personal credit in the same way that a personal loan or personal credit cards do. Also, a better personal credit rating is going to mean that you're going to get a lower interest rate on your startup loan. Okay, so with the startup loan out of the way, I'm going to focus on some common grants and subsidies that are tapped into by startup founders. These grants are great because they really can leverage and stretch what you just picked up in the startup loan. So first there's SR&ED or SHRED. It's a tax credit refund for research and developmental expenses that you spend throughout the year and then you claim when you file your taxes. So this is a big deal in Canada and it can halve your development costs. But you do have to afford those spends in the first place. So that's why it's good for leveraging a startup loan. Next, we have IRAP, which it's a cost sharing program. So basically you get reimbursed for up to 80% of salaries and 50% for contractors on a regular cadence. So it funds faster than SHRED, but you need to predefine the work and you can't start until you're actually approved. Plus, IRAP's funding timing is quite unpredictable throughout the year, so it can be quite frustrating until you get to know how it works. But the upside is once you have a relationship with a rep, then you get greater certainty and on funding. The next is CAN Export. So that one's really great. It's contributions towards export marketing activities. So first you have to have reached 100K in annual revenue in your last reporting. But once you've done that, you really should tap into this because it funds new markets. So that can factor into your growth strategy. So you really want to sequence it out because each new market you go into kind of unlocks new CAN export potential. So how does this one work? Well, like IRAP, it's funding on a cost sharing basis. So you can submit your budget between 20K and 100K and the program will fund about 75% of the costs. And keep in mind, this program has actually been altered because of COVID. So now there's things like SEO that are covered that are pretty cool. So if you haven't checked it out recently, go back. Okay, now I want to pause for a second and just talk about all the COVID options. So there's SUS, SIRS, CEBA, RRRF, BCAP, HASCAP. There's so many COVID loans right now to look into because you may be able to leverage those. But if not, next you have your growth capital loans, and they're available to corporations that have basically reached financial decent situations. So unlike startup loans, these are adjudicated based on the merit of your financial position of your business. So you need to achieve a strong financial profile. For tech companies, it's important to really sequence your growth plans so that we keep in mind that banks don't fund losses. In other words, you have to convince the bank that what they're doing here is funding an investment in growth, not offsetting losses that resulted from unmet expectations or poor performance. So you want to be proactive, really strategize, get in and have the conversations with the bank. Timing is really important for growth capital. The next is recurring revenue loans. So SaaS companies can now tap into, they're in and out, these recurring revenue loans. A lot of this type of programming on SaaS financing really requires you to get to 100K MRR before they're willing to consider and lend against you. So that's probably a milestone to hit before you can unlock those. Don't forget about leases when you're purchasing equipment, phones, any kind of assets. like basically anything that's for operating expenses, you should be using cash for. Anything for an asset that you're going to get a value more than a year, use some form of credit. So now we've got also a line of credit, and that will help manage your stress. So if a startup should be able to secure a $50K line of credit, but you may need to get a $10K GIC in order to secure it. As your business grows, however, and your revenues grow, your AR grows, your monthly recurring grows, you should be able to increase that line of credit balance. So talk to your bank and get a sense from them on what they need to see from your business in order to unlock a greater line of credit limit. The next is factoring. So these are when you get in a bind. Tech companies don't generally have a lot of assets that can be liquidated, but shred accruals can be leveraged as are invoices. So these programs tend to have high interest rates, so you don't want to be too dependent on them, but they can help you when you're in a bind and you need to hit payroll, that sort of thing. There's also the shred loans that will fund throughout the year. You usually need to have 3 years of successful shred claims before you can get those loans in place. Don't forget about your customers as well. So customers, if you invoice annually in advance, if you obviously can bring in cash sooner. You can also charge onboarding and customization fees. They may be more acceptable to your customers than you think. Also offer early payment discounts and volume price discounting. It may actually bring cash in sooner than you think as well. Just be mindful of your options. And don't forget, lastly, about hiring grants. So there's a variety of hiring, training, and some are student programs. These can really help stretch your budget. They are more difficult, I think, for companies under like a dozen people to be able to tap into efficiently, but as you're scaling, the savings can really accumulate. Okay, I respect your time. I try to keep these videos short, so I'm going to stop right there. I've covered 12 different non-dilutive funding options. If this was helpful, hit like, share it so more business owners can see it. If you have something that I haven't mentioned, please add it to the comments for everybody's benefit. And if you have any questions or suggestions for additional videos, add those too, and then I will happily entertain those. Thank you for watching.